$63,312. That is exactly where Bitcoin is sitting right now. Today, February 24th, 2026. And if you pulled up your portfolio this morning, thinking it was going to be just another Tuesday, you got one of the rudest awakenings this market has delivered in a very long time. Billions of dollars have been wiped from the total crypto market cap in a matter of hours. And here is what should genuinely disturb you. Nothing broke inside the crypto world to cause this. No exchange collapsed, no major hack, no project failed. Bitcoin's network is running perfectly. The blockchain is ticking along exactly as it always has. So why, on this specific morning, did everything just fall off a cliff? The mainstream financial media will give you 3 sentences about risk-off sentiment and then move on. But what they are not going to tell you, what they are either too lazy or too afraid to explain, is that there is a direct, mechanical, provable connection between the tariff policy coming out of Washington right now and the $63,000 number you're staring at. And that connection goes so deep and touches so many parts of the global financial system that once you understand it fully, you will never be blindsided by one of these crashes again. So do not scroll away. What I am about to walk you through in the next 20 minutes is the most important financial briefing you are going to get today. And that is not hype. That is a promise. Welcome to the Wealth Continuum, where we track the movements of the financial elite so that you do not become their exit liquidity. We do not chase headlines here. We chase the mechanisms underneath the headlines. The actual plumbing of the global financial system that determines where your money goes and why. If you are new here and you value this level of analysis, hit subscribe right now because what we are about to get into is not being discussed on any mainstream financial channel. And before we go further, drop a comment and tell me where in the world you're watching this from today. Your city, your state, your country. Because as we are going to see very shortly, this crash is hitting different regions in very specific ways. And depending on where you are, your local liquidity situation may be far more exposed than you realize. Tell me where you're at right now. Now, the story of what is happening today did not start this morning. It started building over many months, and there were warning signs everywhere. If you knew what to look for, cast your mind back to early 2025. Trump returned to the White House and within days signed an executive order imposing 25% tariffs on imports from Canada and Mexico and an additional 10% tariff on Chinese goods. That was only the beginning. Throughout the rest of 2025, the tariff agenda expanded aggressively. Technology imports got hit, semiconductor restrictions tightened, the European Union was threatened, and by 2026, the United States had constructed a wall of economic pressure around the entire global trading system. The most recent escalation, the new 15% broad global tariff structure that landed in recent weeks, is the trigger that has finally unleashed the full-scale market event we are living through right now on February 24th. Most people looked at that tariff announcement and thought about grocery prices and car costs. They did not think about Bitcoin, but they absolutely should have. Because here is what they are not telling you about what tariffs actually do to the global financial system, and to crypto specifically. When the United States raises tariffs, it does something very specific and very powerful to the US dollar. It makes the dollar stronger. Foreign goods get more expensive in America, but companies still need them, so demand for dollars increases. Foreign businesses see their margins eaten alive by tariff costs. Global dollar demand rises. Simultaneously, elevated American interest rates, held high to fight the inflation that tariffs create, attract capital from all over the world into dollar-denominated assets. The dollar index surges. And here is the relationship you need to burn into your memory. When the dollar index goes up, Bitcoin goes down, almost every single time. This is not a coincidence. This is not a correlation without cause. This is a mechanical, structural link running through the heart of how the global financial system allocates risk. And today, that mechanism is firing at full force. Stay with me, because the next part of this story is where it gets really concerning. And it explains something the retail crypto community almost never discusses. Global dollar liquidity. It sounds technical, but it is actually simple. It is the total amount of dollar-denominated money flowing through the world's financial system available to invest in assets. When that pool is large and growing, money flows everywhere. Stocks, real estate, commodities, crypto. When it shrinks, money retreats to safety. And what a broad 15% global tariff structure does is actively drain that pool. Foreign governments and businesses holding dollars to cover tariff costs pull money out of the system. When global dollar liquidity drops, the asset class that gets hit first and hardest is always the one sitting at the furthest edge of the risk spectrum. Right now, that is crypto. Not because crypto is broken, but because crypto is the most liquid speculative asset on Earth. And in a liquidity crunch, liquid assets get sold first. Today's $63,000 price is the direct output of that dynamic. Comment below right now and tell me, Did you see this drop coming, or did today catch you completely off guard? Be honest, no judgment here. I genuinely want to understand where the community is at. Now let's add the layer that is making this particular crash more dangerous than the price action alone suggests. The Clarity Act, or more precisely, the stunning failure of the Clarity Act to pass the Senate. Because this is where it gets really concerning for everyone who had been holding crypto based on the promise of regulatory certainty in 2026. The Clarity Act was supposed to create a clear legal framework, defining which digital assets are securities, which are commodities, and how each should be regulated. If it had passed, it would have opened the door for pension funds, insurance companies, endowments, and every form of large institutional capital in America to make real allocations to crypto without legal risk. The entire 2026 bull case was built on that promise. And now that promise is broken. The act has stalled. The legal status of most altcoins remains in murky, undefined territory. Institutional capital that was sitting on the sidelines waiting for clarity has stepped back. And it has stepped back at exactly the moment when macro conditions are also deteriorating. Both forces landing at the same time is extraordinarily damaging. The $63,000 price reflects both simultaneously. But here's what they are not telling you about why the Clarity Act actually stalled. The official story is procedural. Committee disagreements, scheduling conflicts, standard gridlock. But look at the timing relative to tariff escalations, and a completely different picture emerges. When a government pursues aggressive protectionist trade policy, it needs to control capital movement. Trade wars cause money to try to escape the traditional system into assets that are harder to track, tax, and control. Assets like Bitcoin and decentralized wallets that the Treasury cannot freeze. If the Clarity Act had passed and legitimized crypto fully, it would have accelerated exactly that capital flight at the worst possible moment for the administration's economic strategy. Keeping crypto's legal status ambiguous is not regulatory caution. It is a mechanism of capital control. And whether that is intentional or coincidental, the effect on your portfolio is identical: uncertainty pressure and lower prices. Hit the like button if you think the financial rules are being rewritten in real time to benefit the people at the very top. Because the pattern in 2026 is not subtle, and the data absolutely supports that view. Now let me add a dimension to this that almost nobody in the mainstream is connecting: the Federal Reserve. Because the Fed's role in today's crash is just as important as the tariffs themselves, and understanding their impossible position explains why there is no easy rescue coming for this market. For months leading into 2026, the expectation baked into asset prices was that the Federal Reserve would begin cutting interest rates. Lower rates mean cheaper money. Cheaper money means more liquidity flooding into risk assets. That expectation was one of the primary engines of the bull run that took Bitcoin to $109,000. And then the tariffs happened. Tariffs are inflationary. When you tax imported goods at 15%, those costs get passed to American consumers. Consumer prices rise. The Federal Reserve's core mandate is to control inflation. If inflation is rising because of tariffs, the Fed absolutely cannot cut rates without throwing gasoline on the fire. They are frozen, trapped between a slowing economy screaming for rate cuts and a tariff-driven inflation problem that prevents them from delivering. The market was promised lower rates. Instead, it got a trade war and a Fed that cannot move. And you are seeing the result of that betrayal in real time today. Now let's talk about what is actually happening in the order books, because most retail investors are misreading this completely. When you look at buy orders sitting around $60,000, it looks like a wall of support, like defense. Like the market is saying, we will hold this level. But what the largest players know, what they are not telling you, is that a significant portion of those visible buy orders are not real. They are spoof orders, placed to create the psychological appearance of support, to give retail investors the confidence to keep buying the dip at 63, 62, 61,000. While retail money flows in believing it is buying a discount, the large funds are quietly offloading into that demand. By the time the spoofed orders vanish and real price discovery resumes, the retail buyer is holding expensive bags, and the smart money has already exited cleanly. You need to understand this before I show you what's next, because the liquidation data makes the picture even more dangerous. Earlier today, as Bitcoin crossed below $65,000, over $450 million in leveraged long positions were forcibly closed. $450 million of artificial buying pressure, gone. And here is the brutal reality about forced liquidations. They are not the end of the selling. They are the trigger for the cascade. Each liquidation pushes price lower. That lower price triggers the next cluster of liquidations. And when you look at where the next major cluster of open leveraged longs currently sits, it is not at $60,000. It is closer to $52,000. That is a long, painful distance from where we are sitting right now. If the macro pressures driving this move do not reverse, if the dollar stays strong, if the Fed holds rates, if the tariffs remain, There is nothing mechanical preventing the cascade from continuing toward that next cluster. Stay with me, because I need to address something that a huge number of crypto investors are still relying on as their North Star, the 4-year halving cycle, and why that framework has been completely overtaken by macro reality in 2026. The Bitcoin halving happened in April 2024, cutting new daily supply in half. That supply reduction was the engine that drove Bitcoin all the way to $109,000 in January 2025. But the halving only works its magic when demand is stable or growing. When demand is being actively destroyed by tariff-driven dollar strength, by regulatory failure, by forced institutional selling to cover real-world business costs, the supply-side halving mathematics simply cannot compensate. You cannot have supply and expect prices to hold when buyers are disappearing faster than new coins are being reduced. If you are holding purely because of a cycle chart made famous in 2021, you are navigating a 2026 storm with a 5-year-old map. And the altcoin situation is significantly worse. This is where it gets really concerning for anyone holding below the top tier. When Bitcoin drops 4 or 5%, altcoins drop 10, 15, sometimes 20. The amplification in a risk-off event is brutal, and the Clarity Act failure makes it structurally worse. Most altcoins exist in legal gray zones that make them completely untouchable for serious institutional capital. Pension funds cannot buy them. Registered advisors cannot recommend them. Without institutional demand, we are entering what might be called the zombie coin era. Projects stuck in limbo, unable to attract capital, slowly bleeding out while waiting for regulatory clarity that may never come in the time frame they need. 90% of the current altcoin market could stay flat or continue declining for months while Bitcoin eventually recovers on its own timeline. But here is what they are not telling you about the gold market. Because this detail, when you see it clearly, reveals exactly what is being orchestrated at the macro level. While Bitcoin is being crushed, gold is holding. And the reason is not accidental. Central banks, led by China, Russia, and Gulf sovereign wealth funds, have been buying gold at near record levels throughout 2025 and into 2026. These are the same institutions simultaneously selling Bitcoin to defend their currencies against dollar surges. They are moving into the most ancient trusted store of value while decentralized assets face maximum pressure. They are reinforcing the old financial world while the new one is being squeezed. When you see gold stable and Bitcoin down, that is not a market anomaly. That is a deliberate, coordinated shift in where sovereign and institutional money is parking itself in a world of escalating trade war uncertainty. Comment below, type CBDC, if you think the real goal behind all of this regulatory and market pressure is to push the world toward government-controlled digital currencies. Type freedom, if you still believe Bitcoin wins this battle long term. I want to see exactly where this community stands right now. Here's another data point getting almost zero coverage that every serious investor needs on their radar. Stablecoin reserves across major exchanges are sitting at a 6-month low. For context, stablecoin reserves represent dry powder, available buying power sitting on exchanges ready to enter the market and support prices. When reserves are high, potential demand exists on the sidelines. When they drop to a 6-month low, the buyers are exhausted. The people who were going to buy the dip have already bought it, and they are now underwater. When buyers run out in the middle of a macro-driven sell-off, there is nothing left to absorb the selling pressure. You get a vertical drop. You get exactly what we are seeing today. And the connection to tariffs is direct. Large institutions with exposure to both crypto and traditional trade-affected businesses are using Bitcoin as a piggy bank to fund rising real-world operational costs. Value is being extracted from the digital economy and transferred back into the old world economy in real time, right now. You need to understand this before I show you the technical level that every investor in this market needs on their radar. Look at the Bitcoin CME Futures chart. There's a significant unfilled gap sitting at approximately $48,000. In the recorded history of Bitcoin CME futures, these gaps are filled roughly 95% of the time. They represent gravitational targets, levels that prices return to fill before resuming longer-term trends. If current macro conditions persist, tariff pressure, dollar strength, Fed paralysis, clarity failure, that $48,000 gap is not merely a possibility. It becomes the logical mathematical destination for this move. 24% below where we are right now. If you are leveraged, today is the day to take that number seriously. Stay with me, because I do not want to leave you in pure doom, because the full picture is more complex than a straight line down. There's a development in the Middle East getting almost zero Western media attention. Several sovereign wealth funds in the Gulf region have been quietly accumulating Bitcoin over the past 12 months as part of a strategy to reduce dollar dependency. The logic is straightforward. If America is willing to weaponize trade policy as aggressively as 2025 and 2026 have demonstrated, any country with heavy dollar exposure has powerful incentives to diversify away. For some sovereigns, Bitcoin, despite volatility, represents something genuinely valuable. A neutral asset no government owns, no treasury can freeze, no sanction can block. Rumor on high-level OTC desks suggests at least one major Gulf sovereign entity is preparing a significant buy program. If that entry materializes, it could represent the most substantial state-level Bitcoin acquisition in years, and the kind of structural long-term demand that puts a floor somewhere nobody currently expects. But sovereign wealth funds do not step in at 63,000. They wait for maximum fear. Right now, the Fear and Greed Index sits at 5, essentially rock-bottom terror across the entire market. That is the kind of reading that patient, long-term money watches very carefully. In a structural shift driven by trade policy, extreme fear can stay low for weeks or months. The market can stay irrational longer than most investors can stay solvent. But the investors quietly calculating entries in this environment are the ones who will own the next decade of returns. Subscribe to the Wealth Continuum right now and turn on notifications, because we are tracking these sovereign wallet movements and OTC flows in real time. The follow-up analysis to this video goes into exactly which signals will confirm whether a genuine reversal is building or whether the next leg down is still ahead. You do not want to miss it. And share this video right now with someone who is currently panic selling, not to change their mind, but to give them the context to make an informed decision rather than an emotional one. That context could save them from a mistake they spend years regretting. Now let me bring everything together, because there is a layer to this story that transcends portfolio management and gets to something much bigger about the world we are actually living in. The tariffs are not just taxes on goods. They are taxes on trust. They are a signal to the entire world that the rules of the international financial order, rules in place since the end of World War II, can be rewritten at any moment by whoever is in the Oval Office. And when rules can be rewritten that suddenly and dramatically, something fundamental shifts in the minds of investors, governments, and ordinary people everywhere. They start looking for assets that cannot be rewritten by executive order. Assets without a single point of failure. Assets outside the reach of any government's ability to freeze or manipulate. In the short term, Bitcoin is being crushed by dollar surge and liquidity drain. And that is real, it is painful, and it is not over yet. But in the medium and long term, every tariff escalation, every act of financial coercion, every demonstration that the old financial order can be weaponized, adds another brick to the structural argument for why Bitcoin exists at all. The short-term pain and the long-term thesis are both real. Where you sit on the timeline determines which one you experience. This is the question I want you to carry with you. We have lived through a period where tariff policy moved global markets, regulatory promises were broken, and the Federal Reserve was trapped by political decisions it did not make. The $63,312 Bitcoin price on February 24th, 2026 is the clearest single data point yet, proving that crypto is not separate from the geopolitical world. It is embedded in it. Given everything you now understand about the mechanism connecting Washington's trade decisions to your digital wallet, do you believe today's price is the beginning of a much longer decline? Or do you believe it is the painful, necessary compression that always precedes the most explosive rallies this asset has ever produced? Go into the comments right now and give me your honest target. Where is the absolute floor for you? If you think 48,000 before 100,000, tell me why. If you think sovereign buyers and ETF inflows catch it here and we are setting up for the next leg, tell me that and the logic behind it. The comment section on this channel has some of the most intelligent financial conversation on this platform. That is because of you. Do not just watch, think, and talk to me. In our next video, we are going deep into the IMF's quiet discussions around a global framework for digital asset taxation potentially implementable as early as 2027. What it would mean for every wallet holder on the planet, and which assets are most and least vulnerable. You absolutely cannot miss that. Subscribe, turn on the bell, and bring someone with you who deserves to understand what is really happening out here. For right now, keep your eyes on the dollar index. Watch 52,000 like it is the most important number in your financial life. Because today it might be. Stay disciplined, stay cold. And remember, in this market, the person who panics is always the person who becomes someone else's profit. The continuum of wealth does not move in a straight line. It moves in cycles of compression and expansion. Today is a compression day. But every compression day in this asset's history has eventually been followed by its opposite. The question is never whether the cycle turns. The question is always whether you're still standing when it does. Stay informed, stay ahead. The Wealth Continuum. See you in the next video.